This is the complete beginner's guide to Bitunix, which is a crypto exchange where you can buy and sell Bitcoin and a lot of other altcoins. If you don't know who I am, my name is Spicy and I've been trading crypto for the past 9 years. It took me 18 months to become profitable. Also worked at a proprietary crypto trading firm in Sydney. And since then, I've been earning between 60 to 120% per year. Quick disclaimer, this is just an educational tutorial. This is not a paid promotion. So I'm not affiliated with Bitunix, and I'm not telling you that this is the only exchange that you should use, right? You can use whatever exchange you want. But some alternatives are Binance, Bybit, Blowfin, and Hyperliquid. So as with any exchange, please be cautious with how much you deposit because crypto is a risky industry and we have seen exchanges go down in the past. So please do your due diligence. By the end of this video, you will learn how to properly use a crypto exchange. I believe the best way of learning is by actually doing something, which is why at the end of the video, we will be going through a training exercise where we will be entering and exiting some practice trades together. So there are two common problems that traders have when using crypto exchanges. Problem one, they don't know how to actually use the exchange. So they get confused about all the buttons and features. They don't know the difference between spot and futures contracts. They don't know how to manage their counterparty risk with appropriately sized deposits and withdrawals. And problem number two, so they just don't understand leverage. A lot of traders think they know what it is, but they don't actually know what it is. Most traders think that leverage is a risky profit multiplier tool when it's not, and they don't know the difference between cross and isolated margin. They don't know what leverage settings to use on the exchange, and their lack of understanding can sometimes lead them to blow up their trading account, or the opposite, which is just be way too scared to take any trades. The 5 lessons in this video, they solve both problems completely. And also, right at the very end, as you can see, I've thrown in a little bonus training exercise that we'll be going through together as well. All right, let's get started. Lesson 1, account setup on Bitunix. So I'm going to show you how to create an account in less than 5 minutes. All right, so to sign up, it's really easy. You just click this button here once you're on the home page. You just click start now, and then you just, where is it? Here we go. Don't have an account yet. Just click register now, and then just put in your details, register, and yeah, that's pretty much it. It's fairly simple and straightforward. You just put in your email, and then after that, you just have to check your email for like a confirmation, and yeah, fairly simple, fairly straightforward. Lesson 2, deposits and withdrawals. This is also going to be a fast lesson. I'm going to show you how to deposit and withdraw funds from the exchange. And I'm also going to share my logic for when I deposit and withdraw between the exchange and my crypto wallets. So deposits are fairly simple and straightforward. Hover your mouse over the top right-hand corner for the wallet button, and then just click deposit. So it's going to bring you to a page like this. So I prefer doing all of my deposits and withdrawals in Tether USDT. It's very fast and the fees are super cheap. And specifically on the Tron network. This one is just my favorite in terms of speed and fees. So if you don't have any USDT, or if you do have USDT, but it's stuck in a wallet on a different network. So for example, if you might have USDT, but it might be in Ethereum, not a problem. You just pick whatever you have and you just go and deposit it. Now, if you, let's say you do have crypto, but it's just not in Tether, but instead it's Bitcoin, also not a problem. You just go and deposit that. So after you deposit your crypto, it's going to land into your spot account. If you deposited USDT, all you have to do is just click transfer and then transfer it over to your futures account. Fairly simple and straightforward. If you deposited a different crypto, so not USDT, let's say you threw in a bunch of Bitcoin and ETH, what you're going to have to do is you're going to have to convert that into USDT. How you do that? Super simple. You just click trade and then just click this button here. Just click trade. And then whatever Bitcoin you have, you just click here and then you just drag this up to 100% because now we're going to be selling all of our Bitcoin. So I have 0 on the account right now, but let's just say I had $100 worth. Then I would just click sell and then bang. As soon as I do that, I'm going to have the 100 USDT. If you don't have any crypto, not a problem. Just go to the top right-hand corner to the wallet button again, and then just click this one, buy crypto. And then click the first option, one-click buy. It's going to bring you to this page. So from here, you just select whatever currency you want to use or whatever your local currency is. So example, $Australian. Then I'm just going to type in 150 and this should give me about almost 100 tether, 100 USDT. And then from there, you just select your preferred payment method, click buy, and then go through the process. They also have a little disclaimer up here. They basically say that when you're using certain payment methods for the first time, it may require additional KYC verification. This basically means that if you're using a payment provider for the first time, you may need to provide some documents to prove that you are who you say you are for the financial regulatory reasons. Something that I really strongly recommend that you do, if this is your very first time depositing to a crypto exchange, is to just deposit 100 USDT and no more than that, right? You don't need to deposit your entire trading account onto the exchange. 100 is more than enough to just be comfortable with clicking all the buttons, buying and selling a whole bunch of stuff, just getting familiar with the platform without the fear of losing cash. This is like play money or practice money. And like over time, you can always gradually deposit more as your skill improves and as your confidence improves as well. By the way, here is an important reminder. So crypto exchanges, they can get hacked, they can hold withdrawals, they can freeze funds, and they can completely collapse. These bad things have happened before in the past, so it makes sense to assume that it can happen again. So then it would also make sense to be prepared with a system that can handle a worst case scenario. So now I'm going to show you my withdrawals and deposits system. This is my deposits and withdrawals system that I use to move money between my bank and also crypto exchanges. And quick disclaimer, this is not me saying you have to do it in this way. I'm just sharing the way that I do it. You can do it in whatever way that you want. I also share the reason for like why I do it in this way. So let's get into it. So I've actually color coded everything based on how risky I think it is to put your money inside that thing. So green is low risk, yellow is medium, red is high. And when I say risk, I just mean like if you were to put your money in this thing, what is the likelihood that your money is gone skis, that you have to say bye-bye to your money, right? What's the probability that you literally lose everything that you have deposited into that thing, right? And my reasoning or my logic here is that something that is low risk, because it's very low risk, I can get away with putting more money into that thing or holding more money in that specific thing. Whereas if something is high risk, I won't be able to get away with holding a very large amount of funds relative to my total funds in that thing, because it's more likely that I lose the funds that are in there, right? So I have a bank as green as the lowest risk thing. I have a secure cold wallet, so think of like a physical crypto wallet, as yellow. And then I have a crypto exchange or a futures exchange as red, and the highest risk things. So my logic or my way of thinking is this is where I'm going to be parking most of my capital. This is where I'm going to be parking a little bit less than whatever is in here. And then in the futures exchanges, this is where I'm going to be parking as little of it as possible, right? So, okay, let's go through the diagram step by step. Oh, there we go. Okay, so I'm going to start with money in the bank. If I have no crypto at all, I'm going to have to buy some crypto. And I've put it in brackets here. I'm probably going to have to pay a premium. So it depends with like which exchange or which provider you end up using. So for example, Coinbase, Bitunix, I think MoonPay is another provider. Depends which one you use, but you might get different fees depending on whether you use your credit card, whether you use a bank transfer, whatever. And I think it just depends in like which country you're in. So I can't really recommend what is the best one. All I can really say is you're gonna have to do a little bit of research to see what is actually the most convenient, and also what is the exchange with the lowest fees for your specific currency. Something that's popular now, which wasn't really popular like back in the olden days, was you can actually get funds on a futures exchange like directly without needing a separate exchange. So like for example, I think Bitunix offers it. Yeah, Bitunix offers it now. Bybit offers it. I think Binance offers it as well. I think a few other futures exchanges offer it, where you can basically buy USDT or buy Bitcoin with your fiat currency, like with your local currency, with like credit card or with a bank transfer, like directly on the exchange. I personally don't do that. Nothing wrong with that. It's just I just have a preference to keeping like everything separate. So that's why I just go through my spot exchange. Now, once I've moved fiat onto my spot exchange, when it's time for me to buy crypto, I actually could be buying it for two different reasons or for two separate holdings. So my first holding is actually for my long-term investments. And then my second holdings is for my short-term trading, right? And I actually keep these two completely separate. You can keep them like in the same bucket if you want. I personally just don't like having that approach. I just prefer one specific bucket only for long-term stuff, and then another bucket just purely for the really active, really day-to-day, intraday trading type of stuff. All right. So any time that I want to DCA into Bitcoin or hold it for the long term, I go transfer that that Bitcoin over to the to one specific cold wallet number one. Anytime that I need crypto for trading, I'm going to be buying USDT with my fiat currency, with my local currency, and I'm going to be moving it to a different secure wallet. Now, once it's in this other secure wallet, let's just pretend that I'm working with $10,000, right? Where should I draw? I'm going to draw up here. $10,000. Right, so I have 10,000 in this in my trading cold wallet, and I have 0 in the futures exchange. Well, I won't be able to trade then because I need some money on this futures exchange. But the problem is I don't know if I want to have all the 10,000 on the futures exchange, because remember, futures are high risk. So what I do is I'm only going to be depositing 1,000 onto the exchange. So only 10% of my trading account, right? Just throw a $sign. There we go. But what I can do if I still want to trade with the entire 10K is I just use 10x leverage to compensate for the funds that I don't actually have on the exchange. That way I can still trade with $10,000, and whenever, like let's pretend that I lose a few trades in a row, not a problem. I'm just going to deposit from the wallet onto the exchange to top it up, to refill it, right? And then whenever I go on a big win streak, also not a problem. I'm just going to be withdrawing funds from the exchange and pulling it back into the wallet. So let me walk you through this. So let's say I've got the 9K on the, so I've got 9K on the in the wallet, and then 1K in the exchange, right? Let's pretend that I lose a bunch of trades and I'm now sitting at, there we go, 500 and 9,000, right? Because I lost $500 in my most recent trades. So now my exposure on the exchange is a little bit too low, and I'm going to need to use way more leverage than normal to compensate for what I don't have on the exchange. And 5% is low enough. So this is where I'm going to be depositing 500 into the exchange like that. So I've moved 500. And then let's pretend that I win a bunch of trades. My maximum exposure is 20%, right? So let's say I win a bunch of trades and I'm now at, let's say, 2,000 on the exchange. So I still have 8,500 here. I say, okay, I'm getting really close to that 20% mark. I can now withdraw from the exchange into the back into the wallet. So I'm going to move 1,000 from the futures exchange into the wallet. So that means I'm now going to be at 1,000, and this one is going to be 9,500, right? So at all times, the average, whatever my total trading account is, on average, about 10% is going to be on the exchange, and about 90% is going to be in my secure cold wallet. Yes, sometimes I go a little bit over with these numbers. Like, this doesn't have to be perfect. That's why I put the little squiggly here. It's like if my exposure gets roughly near that 5% mark, it's a sign for me that, all right, it's time to top it up. If my exposure gets a little bit closer to that 20, maybe 25% mark, all right, it's time to withdraw. And my logic here is that I'm going in with the assumption that my futures exchange is going to go down every 4 years, right? Because if we look back in time, we have FTX, we had Mt. Gox, right? That's like two major events in the past, I don't know, 8, 9, maybe 10 years. So I'm going in with the mindset that, okay, whatever exchange I happen to choose to use, maybe there is a chance that 4 or 5 years later, something crazy happens and all of my funds get wiped in that situation. So I want to have my trading process or my system in such a way where even if an exchange goes down, I still have a net profit, right? Because if I have 100% on the exchange and then 5 years later it goes down, then all the profits that I made, they basically were meaningless, right? So that is not, in my opinion, not an ideal plan because of how many times we've seen exchanges go down, right? But if my exposure is about 20%, think about it. If it's maxed out at 20%, that means I lose 20% of my account every 4 years. This is me being pessimistic, but also safe, right? This is the same thing as me losing 5% of my account every 1 year. So, but I treat hacks, rugs, exchanges committing blatant fraud, theft, some other problem where I lose my funds on the exchange. I'm not treating it like, oh, I'm a victim. I treat it like, oh, this is like a literal natural cost that we have to take if we want to play in the Wild West known as crypto. And that cost is every year I'm going to lose about 5% of my trading account, which is crazy. But considering the returns or the potential returns of crypto, I treat it like, okay, I think that every year in crypto, if I can by far massively exceed whatever this number is in returns year by year through trading crypto, then it's worth it. So like, for example, if I make 60% per year, after 1 year, so I make 60%, and then on average, I have to pay a 5% tax on that. So it's like, all right, a 5% crypto is crazy tax. Then all right, I still end the year with 55%, which is actually not too bad. Like, that's actually not too bad. And this absolutely 100% is possible in crypto because of how risky crypto is. Like the nature of a very risky industry is that it also provides outsized or abnormally high returns when compared to like more traditional types of markets, right? So because it's so risky, this is why, and because so much crazy stuff happens, right? This is why I have a system in place to kind of protect myself against those situations, so that even if like 10 years down the line, I have to face 2 hacks and 1 exchange going down, I think that I'll still be fine. All right, that covers the deposits and withdrawal system. Lesson 3, spot and futures. There are 2 ways to buy Bitcoin or other altcoins. They are completely different. Okay, so spot, this is the real thing. Spot Bitcoin is referring to real Bitcoins. You own it. You can withdraw it. It's yours. And with futures, you are buying a contract about the thing, not the thing itself. So one Bitcoin futures contract is not a real Bitcoin. You are not buying the asset itself. What you are buying and selling is a contract which is based on the price of the asset. And the main use of futures is to speculate and or to hedge. And you also can't withdraw it off the exchange. To help understand futures contracts a little bit better, which are used for hedging and speculating, as I said on the previous slide, let's go back in time to 1950. Pretend that you are a cow farmer. You have 100 cows ready to sell at $1,000 per 1 cow to a meat packing company in 6 months from now. But you have a problem. What if the price of cows dropped by 90% in the next 6 months? Instead of making $100,000, you will only make $10,000. Sad face. But here's the solution. you can short cow futures and close the position in 6 months from now. So when it's time to sell to the meat company, you'll only get $10,000 from the company, because 100 cows times $100 is $10,000. But your short position would have earned $90,000 because it dropped 90%. So, and you're trading with a $100,000 position. So 90% multiplied by 100K is $90,000. That's what the profit on your short position would be. So your total revenue would be $100,000 because you've got the 10,000 from the company and you got the 9,000 from the short position. So total is $100,000. So that short position, it saved you a lot. And if the price of cows goes up, so the opposite situation, the profit is still going to be exactly the same. So when it's time to sell to the meat company, you will get $150,000 from the company because 100 cows times 1,500 is 150K. But your short position would have actually lost $50,000 because we have 50% of 100,000 is just 50,000. So your total revenue, again, is going to be $100,000 because it's just the 150 minus the 50, right? So your short position, it protects you from the downside, but it also won't let you profit from any upside. So your risk to the price of cows is now hedged. So if the price goes up, down, or sideways, your revenue for your cow business is locked in and unaffected. Using futures contracts to protect yourself from price risk is called hedging. Now let's talk about speculation. Pretend there is a trader in Chicago who has never seen a cow in his entire life. I think beef prices are going to go up, so I'm going to go buy some cow futures contracts at $1,000 a cow and sell it later for a profit. So what he's doing is he's getting long on cow futures because longs are betting on price to go up. So this trader doesn't actually want any cows. He doesn't even care about cows. Well, I'm sure if he met a cow, maybe that might change, but for this example, let's just pretend he doesn't care about cows. He just wants to profit from the price movement of cows. So here's a quick summary. So with spot, you buy the thing, likely because you want to actually use the thing. And if you want to profit from the thing, it's going to have to go up in price. But with futures, you're betting on the prices of things. You don't actually own the thing that you are trading. And if you want to profit from the thing, you can profit from price going up and down. Okay, so here's why I trade futures, not spot. So for most financial products, at least in crypto, there are more people who want to speculate on price rather than actually use the product. So this causes the average trade volumes to be bigger and the order books to be thicker in futures compared to spot. So this naturally leads to futures having cheaper fees and having lower slippage costs. Futures also allow traders to use leverage to open larger sized trades relative to whatever is deposited on their crypto exchange. And also, futures allows traders to be a lot more efficient with their capital, thanks to leverage. So here's what I do with spot. So whenever I want to add real Bitcoin to my long-term portfolio, I'm going to buy some spot. I will then withdraw it from the exchange and into my own wallets because not your keys, not your coins, right? So basically, I use futures for my short-term bets and I use spot for my long-term holdings. That's it. So I keep it really simple. In the next clip, I'm going to go on Bitunix and we're going to quickly talk about spot and futures, funding rates, and mark and last price. Okay, I'm going to quickly cover spot and futures on Bitunix. So let's go to the upper toolbar and go to spot and just click that. And straight away, by default, it's going to bring you to Bitcoin/USDT. So since this is spot Bitcoin, if you buy any spot Bitcoin, it's going to go into your spot wallet. And anytime that it goes into your spot wallet or your spot account, you can actually go and withdraw that into into another exchange, or you could withdraw it into your own wallets. If you are depositing, let's say, Bitcoin, and it landed into your spot account and you want USDT, then you just click the sell button and then you just go and sell however much Bitcoin you want for USDT. And then you can just go and transfer it out into your futures account. And then for futures, the one that I recommend is the USDT-M, not any of the other ones, just because these ones, so the USDT, so trading against Tether, this one is the one which has the most amount of volume, the most amount of liquidity, so therefore the trading costs are probably going to be at their absolute lowest. So yeah, spot and futures, fairly simple and straightforward. It's just right up here. Now I'm going to be talking about the funding rates. So in this upper toolbar, at the very right-hand side, you will see funding rates. So this is the thing that I will be explaining. Something that you'll notice is that the price of futures is going to be very, very close to the price of spot. So if we look at spot Bitcoin right now, it's $81,029. But the futures price is $80,950, right? So it's very close, but it's not exactly perfect, right? So it's going to be fluctuating, and the size of the gap between the two prices, this also fluctuates, but the majority of the time, they're going to be very, very closely linked. And the thing that keeps the two prices linked together, it's the funding rate. So the funding rate is basically like an interest rate payment that shorts have to pay to longs, or the opposite, that sometimes longs have to pay to shorts, right? So if this value is negative, that means that shorts have to pay longs. And if this value is positive, that means that longs have to pay shorts. And for Bitcoin, this interest rate payment will come every 8 hours. For other altcoins, you will notice that this, like how often this interest rate payment will come, it might depend, it might vary, it might change, depending on which exchange you're using, and also depending on what coin. So sometimes this can be brought down to 4 hours, sometimes it can be brought down as low as 1 hour. How this value is calculated is actually based on the difference between the futures and the spot price. So if the futures price is above the spot price, this funding rate is going to be positive, and longs are going to have to pay shorts. The reason why it's built in this way is because without this funding rate, it would be really easy to just manipulate the price of futures, because you could just keep buying them indefinitely with no consequences, right? But as this gets more and more mispriced, this funding rate is going to get wider and wider and wider. So this means that if you are shorting futures when there is negative funding, you're actually going to get paid to do that, right? So there is some incentive to kind of reduce the buy pressure and also increase the sell pressure. So if we reduce buy pressure and increase sell pressure, then it's going to drive the price down. And the same goes in the opposite direction too. Let me just delete these little things. So if the futures price is below the spot price, let me just pan up a little bit. There we go. If the futures price is below the spot price, as it currently is, this means that short positions are going to have to pay long positions. This means that if you're currently short, in exactly 4 hours, 49 minutes, and 17 seconds, you're going to have to pay a fee, which is this much, which is 0.0026%, to everyone who is long. So that means that if you have let's say a $10,000 long position, the size of your funding rate fee for being short, so if you're currently short, you will have to pay your position size multiplied by whatever this value is, and whatever that value is, that gets redistributed to people who are currently long, right? So just to quickly sum up, the funding rate is the thing that helps control the mispricings in futures. If it is positive, that means that longs have to pay shorts. If it's negative, this means that shorts have to pay longs. and the size of this funding rate. So how big of a fee do you have to pay, or how big of a fee are you going to get paid? This entirely depends on how big is this gap between the futures and the spot. Now I'm going to explain mark price and last price. So on your chart, on this upper toolbar, you will see this little button here which says last price and mark price. So last price, if you select this, actually if you just change what this is, it's just going to change the candlestick chart that you're looking at just very slightly, like very, very slightly. So when we select last price, what we're looking at is this is the price action for this specific product on this specific exchange. So what is the last traded price? What was the most recent trade that went through? What was the price of that on this specific exchange? Bitunix, right? This is what last price is. Mark price is slightly different in the sense that what the chart is showing here, this is more like of a, what is the fair price of this product, which takes a whole bunch of different calculations for how it assumes or how it calculates what is the so-called fair price of Bitcoin. Not what is the last traded price of Bitcoin on this specific exchange, but what is the fair price of Bitcoin? And the way that they do this is they would look at what is the average traded price of Bitcoin across a whole bunch of exchanges, and they will give different exchanges different weightings, right? So I can actually just go in info here and I can take a look at it. So you can see here it says index source, BitGet, Binance, and Bybit. These are the three exchanges that Bitunix is using to determine what is the fair price or the mark price of Bitcoin. Now I'm going to explain the actual use case between mark and last price, and when you're supposed to, or when I would recommend for you to use mark versus last. And I've boiled it down basically to this. If you're swing trading, so if you're taking like 1 or 2 trades every month, then I would recommend for you to rely on the mark price. But if you're scalping or you're day trading, or this is like you're taking somewhere between 10 to 30 trades per month, then I would recommend for you to just use last. I'm going to explain the reasoning for why as well. So this mainly just applies whenever you're placing a stop loss, right? So let's say I want to put my stop loss, let's say I get long immediately, like right here, and my stop loss is at these lows, right? What can happen is, let's just pretend that some random guy logs in and he market sells $10 million worth of Bitcoin futures on Bitunix. So he literally creates a candle, a down move like that, just purely from his enormous order. If I was using last price, I would get stopped out. If I was using mark price, I would still be in the trade, right? So I wouldn't actually be stopped out. So if I was using mark price, I would be protected against those very random, very rare type of mispricings that happen like once a year or like once every 2 years, like very rare. And also, by the way, they're never that big. These type of exchange mispricings, I would say like at most, like literally at most, it's going to be like 0.5% or maybe like 1% wide, something like that. So very, like not outrageous, right? But it still can happen. Like, yeah, like I said, once a year or once every 2 years. So mark is going to protect you against that. But there's a downside to using mark if you're scalping or day trading on a regular basis. And that is that the mark price has a little bit of a lag to it. Meaning, let's say you took this long position and your idea was just wrong and price went down here, not because of some random mispricing, but like the price of Bitcoin on all exchanges started to drift down and then eventually it hit this price, right? The mark has a little bit of a lag to it, so your stop loss might actually execute a little bit later than normal. So instead of taking the loss somewhere down here, you might actually take the loss somewhere down here, a little bit lower. So the reason why I have mark and last set here for swing or for scalping is if you're scalping intraday, these extra losses, they massively add up, right? Like if you're taking 30 trades a month and let's say you have a 50% win rate. So 15 trades, you're losing an extra 0.1R or 0.2R. That and like over the course of a year, that is going to massively hit you, like massively, massively hit you. But if you're swing trading, these extra, like the costs of you paying a tiny, tiny extra fee on just like an extra 5 trades, because the frequency is low, the cost from using mark, it's not like it doesn't compound and it doesn't add up, right? But the cost of you lose 1 trade because of an exchange mispricing out of like 300, it's not that big of a deal. It's not going to impact your P&L. But when you're swing trading, the impact of having 1 trade be a loser instead of a giant winner, this can have a huge impact to your P&L, right? So basically, we're trying to measure like, or this is how I think about it. It's a pick your poison type of situation. Would you rather pay significantly higher fees to protect one winning trade, like one giant winning trade, or would you pay like would you have lower costs, but maybe like once a year instead of winning 1 trade, you lose a trade, right? And this can actually go both ways. So you can sometimes get lucky in the opposite direction where thanks to an exchange mispricing, you actually win a trade rather than lose. But like in simple terms, I would just boil it down to this. If you're swing trading, I would recommend to use mark. If you're scalping, just use last. And if you're watching this video, it's very likely that you have taken fewer than a total of 300 trades in your lifetime. And if that's the case, I would strongly recommend that you actually just stick to the low time frames, really get those reps in. And then gradually in the future, you can transition to swing trading anyway, like with all of the skills that you develop on the low time frames. And then you switch over to swing trading and using mark price. But yeah, for like 99% of the people who are watching this video, just use last price. It makes things so much easier, and there's just less shenanigans that occur if you just stick to last. Lesson 4: leverage and risk settings. In this lesson, we are going to cover 4 things: what most traders think leverage is and what it actually is, cross margin versus isolated margin, leverage settings, and also position sizing. I want to start with a mini leverage quiz. Pretend that 1 Bitcoin equals $100,000. Trader A gets long 1 Bitcoin with 1 times leverage. Trader B gets long for 0.9 Bitcoin with 10 times leverage. The price of 1 Bitcoin increases by 10%. So it goes up from 100K up to 110K. Which trader makes more money? So normally I would let you think on a quiz, but on this question, the answer should come immediately. So if you answer trader B, that is the wrong answer. The answer is actually trader A. And that's because position size is the thing that determines profit. So whoever had a larger position, and assuming they entered, both traders entered at the exact same price at 100K, and the price went up by 10%, whoever had more is going to make more, right? Leverage just changes the margin requirement of the trade. It doesn't change the position size of the trade, only the margin requirement, right? So this position is going to require $100,000 of margin on the exchange. But for trader B, he only needs 9,000 US dollars of margin on the exchange because he's got that leverage cranked up to 10, right? But the actual profit of the position after it gets closed, right? It's going to be different, right? So this one is going to have a higher profit just because the position size is 1 BTC, right? So leverage is just a tool to reduce counterparty risk. Counterparty risk is just simply how much money you need to hold on the exchange in order to take the position size of the trades that you actually want or that you need to take. Okay, so leverage is not a profit multiplier tool. It's just not. Margin is the collateral that you put up in order to take the position. So this is the only thing that leverage affects. It's just your margin. Here's an analogy to make it easier to understand. So imagine that you're trying to buy a house for $1 million. If you buy a $1 million house upfront with cash, or if you put up $100K collateral to get a $1 million loan and then buy the $1 million house, and then if the value of the house goes up by 10%, your profit in both situations is identical, right? In both situations, you're going to make 100K profit on this one, and you're also going to have 100K profit in this situation too, okay? This is because a $1 million house is still a $1 million house, regardless of how much money you borrowed in order to go and get it. So the only thing that is different in both situations is just the collateral. So how much money you put up in order to try to get that $1 million house. So it's just the margin. So in this one, the margin was $1 million. This is the same thing as entering a trade with 1x leverage. But this one, where you put 100K collateral to the bank to get a $1 million loan, and then you go and buy that $1 million house, this is the same thing as using 10x leverage, right? So I'm going to repeat myself just one last time to really drill this point because it is an important one. Leverage only changes the margin requirement of a trade. It does not impact the profit or loss of a trade at all. 0%, nada. I want to show you how you can calculate your position size inside TradingView really quickly. All right, so you want to throw on your risk reward tool. So this can be either the long or the short position. I'll just throw on a long. Then wherever your stop loss is placed, that distance from the entry to the stop loss, this is your risk, right? So what your risk is if my idea just so happened to get stopped out, after I get stopped out, how much USD did I lose, right? So whatever that number is, that's what your risk is. So your risk is different to your position size. Your risk is just how much am I going to lose if my trade idea is wrong. Your position size is how much of the coin do you actually need to buy? So for example, if I was to double click on the risk reward tool, and let's pretend that my account balance is $1,000 and I'm risking 10 USDT. By the way, you want to keep the lot size to 1, otherwise it's going to start getting really glitchy. That's it. Super simple. What is my account size? 1,000. How much do I want to risk on the trade? 10. That means that if this trade was to get stopped out, like from this point all the way and hit the stop loss, I'm going to lose 10 USD. In order for me to lose 10 USD on this trade, how much of this coin do I actually need to buy? Well, if you hover your mouse over the risk reward tool, you'll see here that the 1.01, this is like your actual risk reward ratio, but this number in the top right of this number, so the 504, this is what your position size needs to be such that if your trade loses, you're going to lose the $10 on the trade. And I'm going to walk you through like why, like where did this number even come from? So let's do the math together. If I was to buy 504 play coins, so I buy or I get long 504 coins, how much does that actually equal in USD? Well, the price of it now is 0.13. Let's do some quick maths. So what is that? 504 times 0.13. It's 65 USD. All right, cool. So it's 65, roughly, say roughly 65 USD. You know what? I'll make the font a little bit bigger so it's a little bit easier to see. All right, there we go. Okay, now my stop loss is 15.16% away. So if I was to get stopped out, this is how much of my position I'm going to lose. So what is that same number multiplied by 15%? It is 9 So 0.15, so that's the percentage. Actually, I'll just do the percentage and make things easier. 15.1, I'll round up. 7 multiplied by $65 equals, it is 9.8. So it's not exactly $10 of risk, but it's close enough, right? It's close enough. So yeah, whenever you need to calculate your position size on the exchange, first throw on the risk reward tool and go and find the place where your trade idea is invalidated, and then double click on the risk reward tool. Oh, and by the way, I recommend doing all of this inside TradingView, not actually inside the exchange. I personally prefer doing all of my analysis on TradingView and just doing all of the execution on the exchange. This is just because TradingView is a lot more smooth. It's a lot less laggy. But yeah, you just do that, and then you just look at the number. What's the number on the top right? That's how many coins you need to enter the position size such that your risk requirements are actually met. That's it. Super easy, super simple. In the next clips, I'm going to explain isolated and cross margin, and I'm also going to show you my default leverage settings. Now I'm going to be talking about cross and isolated margin. And don't worry, I'll try to talk slowly and also in simple language, because I do understand that this is a commonly misunderstood topic. Okay, so whenever you're using leverage on a crypto exchange, most exchanges that I know of, they have two options for your margin mode: cross or isolated. And when you select it here, it also explains the description between both. Okay, so when you're using cross margin, what this means is that whatever funds that you have in your futures account, that entire futures account is being used as margin for your trade. Meaning that if that trade just so happens to get liquidated, your entire futures account will also be liquidated as well, okay? When you are using isolated margin, it's not your entire account that is being used as margin. It's only a specific isolated, like a section of your entire futures account. And it just depends on what is the position size of the trade that you're taking and what is the leverage that you selected once you actually took that trade, okay? So at first glance, it might appear like isolated is safer because, oh, if I get liquidated, I'm not going to lose the whole thing. If I use cross, I'm going to lose literally the entire futures account. So therefore, surely isolated is safer, right? This is the first assumption that people make. However, this is not always necessarily the case. I'm going to explain the pros and cons between both of these. Okay, so when you're using cross, so how much do I have in this account at the moment? I've got about $90. If I open a $90 position on Bitcoin, my leverage on that trade, since I'm using cross, it's going to be the position size divided by how much actual margin do I have, or how much available funds do I have in the exchange. So if I open up a $93 position, my leverage on that trade is going to be 1, because it's just 93 divided by 93, it's 1. If I open a 100, actually no, before I move on to the next section, what is my liquidation price going to be with a $90 position on cross? It's going to be literally 0, because price, in order for me to get liquidated, price has to drop 100% because I'm on 1x leverage. If I open a $180 position on cross, so it's 2 times whatever my trading account is, I'm going to be on 2 times leverage. This means that the amount that price has to drop before I get liquidated, it's not going to be a 100% drop. It's going to be a 50% drop. So my liquidation price is going to be roughly 50%. This is supposed to be a 5, by the way. It's going to be roughly 50% to the downside, okay? If I open a $930 position with cross, then my stop loss is going to be 10% away, right? So my liquidation price is going to be calculated based on how big is my trade, and how much money do I actually have on the exchange. Okay, that's what cross is. With isolated, if I put 10x leverage on isolated, that means that by default, always, my liquidation price is going to be about 10% away. If I am on, let's say, 2x leverage, then my my liquidation price is going to be about 50% away. If I'm on 100x leverage, then my liquidation price is going to be about 1% away. So on isolated, my liquidation price is always going to be that fixed amount, just relative to the leverage. And on cross, my liquidation is always going to be based on how big of a trade am I actually taking. Okay? So that's the small differences between isolated and cross. So when does it make sense to use cross and when does it make sense to use isolated? Here's how I think about it. For me, it only makes sense to use isolated if I have my entire trading account on the exchange, because if I get liquidated, I don't want to lose literally my entire trading account, right? So I will need to use isolated to protect myself against that situation. I'll use cross if I don't have my entire trading account on the exchange. So what I mean by that is if I have a $10,000 trading account, I can have $9,000 in a crypto wallet of like my own personal crypto wallet. And then I can only have 1,000 unless I have just 1,000 on the exchange. Okay. In that situation, I would just prefer to use cross. I would prefer to use cross because I'm already going in with the mindset that, okay, I've allocated a certain percentage of my trading account that I need to actually sit on the exchange so that I can go and take trades. Like the entire purpose or the whole function of this futures account, it's just margin. I'm using this so I can actually go and take trades. I'm not entirely sure for what type of strategy requires isolated or what kind of strategy truly demands me to have the entire trading account on the exchange. Maybe it would be like some arbitrage type of strategy or I don't know, some obscure type of strategy. But for standard like day trading, intraday trading, or like low time frame trading, I would much prefer to use cross. The main benefit of cross is that, well, when you're on cross, most of the time you're going to have a much wider liquidation price. So the probability that you get liquidated on a trade is going to be like super close to zero. As in your stop loss price, let's say I get long like right here, my stop loss price is going to be somewhere here, and then my liquidation price is going to be literally like at zero or like at like 20% away, right? So my stop loss is always going to be hit well in advance compared to the liquidation price. So there's just no way I'm going to get liquidated. Or like maybe there's a chance if like the exchange lags or something like that. But worst case scenario, I don't lose my entire trading account. I just lose whatever is on the exchange. And that's already a specific percentage of my account, right? So cross just makes everything easier. If I'm using isolated, the problem with this, if I'm day trading, is for every single trade, I'm going to need to do additional, like I'm going to need an extra step to calculate what is the appropriate leverage that I'm going to need to take this trade. Whereas with cross, it just automatically calculates it. Okay, so to wrap up my point, I'll just give some final tips. So if you are trading on the low time frames, you don't need your entire trading account on the exchange, right? You don't. So that's tip number one. Don't have your entire trading account on the exchange because it can go down. Tip number two is if you have only a certain percentage of your account on the exchange, then just use cross because it's going to make your life so much easier because you're not going to get your liquidation price is going to be so far away. And as long as you are using a stop loss on every single trade, all of your losing trades should just be stopped out. They shouldn't be liquidated, right? The distance between whatever your stop loss is and your liquidation price, it's enormous. So you're not really carrying any liquidation risk here. And isolated, it only makes sense if you literally have the entire account on the exchange. And as I said earlier, you probably shouldn't be doing that unless you have a really, really good reason to do that. Lesson 5. Trade entries and exits. In this lesson, we will cover market orders versus limit orders, crossing the spread, and also trading costs. Let's start with market orders versus limit orders, because that's the easiest one. So in all markets, there are makers and takers. Makers, which is basically the same thing as limit orders. So a maker is someone who is making liquidity available to the market. So a limit order is advertising to buy or sell a product at a specific price. In order for the trade to go through, someone else needs to be willing to transact at your desired price. Otherwise, the trade's just not going to go through. So you will need to patiently wait for your trade to actually execute. And yeah, like I said before, if no one wants to transact with you for your desired price, then no trade will go through. So for example, if I'm sitting here advertising that I'm selling one Bitcoin for $1 million when the market price is something like 75, then sure, my limit order goes onto the order book, but no one actually wants to transact and buy a Bitcoin for $1 million. So yes, my order does go onto the order book, but no one is willing to match with me on that specific price, so no trade is executed. But if I say I'm selling one Bitcoin for a price which is like $1 above whatever the last traded price is, then I probably will not have to wait that long for someone to come along and be willing to make that trade with me. Okay, so takers, this is pretty much the opposite. They're just market orders. So a taker is someone who is taking liquidity away from the market. So a market order executes against whatever the best bid and ask price is on the order book. Bid is just a fancy word for buy. Ask is just a fancy word for sell. A trader does not get to choose what price they get if they are a taker. As soon as they click the button, the trade immediately goes through. There is no waiting time, and your trade is guaranteed to go through. But unlike limit orders, 100% of your market orders will be filled, but you just don't get to choose what price they get filled at. Here's a quick little analogy with apples to help understand this concept a little bit better. So imagine we have this guy here, and he says, I wish to buy 5 apples for $1 each. This is a limit order, so he is a maker, right? Because he's making this market. He's sitting here and he's advertising that he's willing to buy a specific quantity of a certain product for a very specific type of price. And if a seller does not match that price, then no trade is going to go through. Whereas we have this guy, he says, I want to buy 5 apples right now. Just give me the best price that you can give me. This is a market order because he's going to be taking liquidity away from the market, right? This guy, the maker, he's going to sit here and he's going to have to patiently wait for someone to match his order. But this guy, the taker, he's just going to get whatever the best or the cheapest price for apples is currently, but he gets his trade executed immediately. Now I'm going to show you market and limit orders on Bitunix. So I'm going to start with market orders because they're just easier to explain. So here, I just type in what is the position size of the trade that I want to enter. I'm just going to type in 10 because I'm just going to keep it simple, and open long. Now, before I enter a trade, the price that I'm going to get is just whatever the best available price is at the moment that I click the button. So what best price means, it's just going to be what is the cheapest limit sell order that is currently on the order book. So if I want to buy $10 worth of Bitcoin, the best price right now is 81,008.5. So this is probably the price I'm going to get. If I'm going to be opening a short, what is the highest buy? It is 81,008.4. Okay? So I'm just going to open along for $10. And as soon as you open it, it should make like a little sound, and it'll also show you your position on the chart as well, which is quite handy. Now, if I scroll down, this is where it shows me information about my open position right now. And also, real quick, by the way, when I have this 10x set on cross, this number, this 10x, this doesn't actually mean that I have 10x leverage right now. No, that is not what it means. It just means that this is the highest leverage that I can access right now on the exchange. Well, this is the setting that I've put. It's like a limitation that I have set for myself, right? This is what what it means when you put it on cross. This means that if I want to enter a long position, the highest position size that I can get away with right now is however much funds I have on the exchange right now, which is 93. Multiply that by 10, so 930. That is what my maximum position size is. But you can see here, my liquidation price, I don't even have one because my margin is $10 over 0.93. It's literally, this trade is literally at 0.1x leverage, right? So I don't even have a liquidation price. Here's going to show you what is your current realized P&L and what is your unrealized P&L. So realized P&L is your profit that is like it's already locked in. And you can see that this is already immediately a negative because I had to pay a fee to enter the trade, and I'm also going to pay a fee to exit the trade. If I want to exit out of this trade, I can select a price and I can also select a quantity. And if I click this button, it's just going to put a limit sell on the order book. So I'm just going to show you now. If I do this, 81.1, there we go. I'm going to do it. Yep, there we go. 81 point. Sorry, I was just misclicking there. Quantity 100% and close. You can see that I have a limit sell at 81.1 for my entire position. This means that if price reaches this point, my trade will close out for a profit and I will exit the trade, okay? If I click this X, it's just going to cancel the order. If I click this button, flash close, it's just going to immediately market close out of my position, and I'm going to just, again, get whatever the best available price is. If I click reverse, and I highly recommend that you don't bother clicking this button, it's going to close my position and then reopen it in the opposite direction. So perfect if you are revenge trading, but if you are taking it nice and easy, then probably stay away from this button. TP and SL, if I click this button, I can go and select what take profit and stop loss I want to be set. Okay, cool. So that's basically all you really need to know. So I'm just going to flash close out of this. So that's how it looks like when I'm entering a position with a market order. So now I'm going to show you how it looks like with a limit order. So here, I'm just going to click, just so I can like do things quickly. I can actually just click on the order book, and whatever price I'm clicking, it's just going to update here. So that's actually quite convenient. So I can click here. Let's say I want to enter a trade for $10. You can see here that I didn't actually enter any trade, but my order did get placed on the order book, right? So I have a limit buy order sitting right here, and in order for my trade to actually go through, I have to patiently wait for the price to return to that point. So we can see here it's like getting closer and closer. If it gets to that point, my order will fill. The other thing that I can do, and this is quite convenient, I can actually click and drag this order to amend or to change whatever price I want for that limit buy order. So I can actually chase the price by clicking and dragging it with this limit order, and I can eventually get filled that way. So you can see that when I'm using a market order, I can get filled. I get filled basically straight away. But when I'm using a limit order, I have to patiently wait for the market to come back to that order. I'm just going to flash close out of this. And there we go. We are done. Also, if you notice that you've closed out of a position, but there's still some stuff lingering on your chart, like an open order or something like that, it's just a bug on the UI. Don't worry about it. If you refresh your page, it should disappear. And the other thing is you'll see these B's and S's on the chart. This just shows you on which candlestick did you buy or sell. Also, one other tip that I'll give before I wrap up this clip is I would actually recommend that you don't bother changing the color scheme on the chart, like on the exchange, because the exchange updates all the time, or like sometimes the cache will be cleared and the settings will just reset back to default anyway. So whenever you want to do anything custom or like have levels drawn on the chart or have like stuff on the chart, I would just recommend to just keep that to trading view and not bother or stress too much about it on the exchange. The only tools that I actually use on the chart of the exchange is just like the long and short tool, and I just copy paste whatever the numbers are from TradingView directly on here, so there's no stress, right? So I'm not actually doing any analysis or anything like that on the chart. Okay, so that pretty much covers limit orders and market orders. I think it's fairly self-explanatory and simple. Now let's talk about crossing the spread. Okay, so what even is the spread? So the spread is just the distance between the best limit buy and the best limit sell. So the gap between these two, that's what the spread is. If I try to limit buy higher than the best limit sell, I'm going to be crossing the spread. If I try to limit sell cheaper than the best buy, that's also crossing the spread. Now I'm going to show you how this looks like. So you can see here that, let me just draw a line, horizontal line at the current price. Below this price are a bunch of limit buy orders, as you can see here. Above this price are a bunch of limit sell orders above here. So you can't limit buy higher than where price is, and you can't limit sell below where the current price is. If you do actually do that, what's going to happen is you're going to cross the spread. Now, whenever you're crossing the spread, this is the exact same thing as executing a market order. So even though the button that I've selected is limit order, if I do it higher than whatever the best sell price is, and then I click open long, it will, because I have, let me just change this 1 second. There we go. So now I've crossed the spread, okay? If I do it in the opposite direction, I'm just going to show you that as well. I'm just going to close out of this immediately. There we go. Oh yeah, quick tip, if you press the X button on the chart, it's going to market close you out of the position. If I want to cross the spread in the opposite direction, so I'm going to select a limit buy price, which is much lower than the best buy. Position size, 10. Open short. Oh, what just happened? Why am I not in a short? Let me try that again. Huh. Okay, 1 second. There we go. There we go. I'll explain what these are in a second. Okay, so I've crossed the spread, and you can see that I had to pay market order fees. So I didn't pay the cheap fee of the limit order. I had to pay a much bigger fee. It's three times bigger. Now, when you're trading on the low time frame, sometimes when you're trying to execute a limit order that's really close to the current price, there can be a really quick, let me just close out of this trade. There can be a really quick price movement, and this can accidentally cause you to cross the spread when you didn't mean to, and you're going to pay a higher fee than you meant. To prevent this from happening, when it says here time in force, you want to just have this set to post only. Okay, have this set to post only. I think by default, it's also going to stay as post only. For most exchanges, this button is actually turned off. I think for Bitunix, it's turned on, but you just want to double check that you have post only enabled, because what this does is it prevents you from crossing the spread. And the way that it does that is, in the event that you try to limit buy higher than whatever the best limit sell price is, your order just isn't going to go through. Oh, let's try that one more time. So I'm selecting a price much higher. It says order place, but you can see nothing actually went through. The reason why it went through last time is because the price actually jumped up, right? But if let's say I select a significantly, like an obviously higher price, $10. So I'm trying to buy at 82,000 when the price is 81. If I click open long, it's just not going to go through. You can see here. Okay, let's say I make it. Yeah, it's not going to go through. It's going to cancel. I don't actually know if it's going to show in the order history that it canceled. Let's take a look. Yeah, so you can see here the status is showing as cancelled. And the reason why is because I was trying to buy at a significantly higher price, or just at a higher price than whatever the best limit sell is. So make sure that you have post only enabled. This is going to save you a lot of a decent chunk of money that you could maybe lose by accident to unnecessary fees. So yeah, to wrap this up, what is the spread? It's the difference between these two prices, the best sell and the best buy. Whenever you cross the spread, this is the same thing as a market order because you're going to be taking liquidity away, right? To prevent you from accidentally crossing the spread, just make sure that you have post only enabled. When does it actually make sense to cross the spread? The only use case for this is if you are trading with very large sums of money and you say, let's say you have a trade idea and you say something like, I want to buy literally all the Bitcoin that is currently available and I want to buy it now with the money that I have, and I'm willing to take everything that's for sale, but I'm going to limit myself to a price cap of 81,400. So for example, right, hypothetical example, if I was to say I want to buy $10 million worth of Bitcoin and no higher than 81,400, and I click open long, what's going to happen is I'm going to eat through all of the limit sells up until 81,400. And let's pretend that there was, let's say, 5 million in limit sells up until this point. So I eat through all of that. And then once price gets to 81,400, there is going to be a giant $5 million order. So the leftovers of this 5 mil is executed as a taker. And then 5 mil is just going to be sitting as a limit buy order at 81,400. So that's like basically the use case, like when you would actually need to go and cross the spread. It's when you want access. It's when you want to take all the liquidity up to a certain point. But if you're watching this video, it's unlikely that you actually need to be thinking about crossing the spread. So for that reason, just have post only enabled and all your stresses and problems will go away. Now let's talk about trading costs. So the main trading costs that you will pay are trading fees and also slippage. And I'm going to be talking about the fees first. So on Bitunix, the fees for market orders are 0.06% per order, or we can just say 6 basis points. 1 basis point is just 0.01%. It's a lot easier to say basis point or BPS, right? And then the limit orders are 0.02% per order. What you'll find is that this fee structure, so 6 basis points for taking or market orders and 2 basis points for the limit orders, this is pretty much the same across most crypto exchanges. So these numbers might seem tiny. So you're like, wow, it's only 6 basis points. So it's only 2 basis points. So they might seem tiny, but they can add up very quickly, like very, very quickly. And I'm actually going to visualize it for you. I built an interactive equity curve simulator using Claude with fee analysis. And basically what this is it's trying to show you what your bankroll could look like after n number of trades, or after you've taken a certain number of trades. So if I slide this, it's going to simulate a new equity curve. The red line is what my profit could look like, or what my bankroll could look like before fees, and the blue line is how my profit or how my bankroll could look like after fees. So if I've only taken a small number of trades, let's say 10, and let's say I have a starting balance of 1,000, I've taken 10 trades, 55% win rate, average win is 1%, average loss is -1%. And let's say the limit order for my entering, so me trying to enter trades, I'm using a limit order. And when I'm exiting, I'm also using a limit order to exit. This is the simulation over 10 trades. If we were to compare the two, the difference in profit is not really that much. So after trade number 10, I would actually be, well, before fees, I would be break even. After fees, I would be down $4. So that's not like, like at first glance, it's like, oh, it's not that big of a deal, right? It's only 0.02%, right? Not that big of a deal. Okay, sure. If we take a little bit more, let's say I've taken 40 trades. Let's say I've taken 40 trades in a month, right? I compare the two, before fees, after fees. Okay, 1148 before fees, 1130 after fees. So total profit before fees, 148. Total profit after fees, 130. I've paid 18 in fees. So how much of my profit did I lose just purely to fees? 12%, right? It's not the end of the world. But if I really crank this number up, by the way, every single time I make a small little change to any of these, it will re-simulate like a new simulation from scratch. That's why some of these equity curves are going to look a little bit different, right? But look here, after I've taken a very large number of trades, so 300, 40% of my fees, 40% of my profit vanishes to fees, because look at this, total profit before fees, 384, total profit after fees, 228, right? So I paid $156 in fees. So 40% of this whole batch is lost to fees. So you can see it's starting to make a little bit of a difference. Now let's pretend that I'm entering a trade with the market order. Now this percentage is a lot bigger, 76.9. That's a big deal. So before fees, I would be up, and let's say I've taken 300 trades in a year. So I'm thinking in terms of like in 12-month windows. So at the end of the year, this strategy would be up 38% before fees, but after fees, it's only up 9%, literally less than 9%. So you can see it's quite a big deal. Now, if I was exiting with market orders as well, this is where it gets crazy. This strategy literally before fees would be profitable. It would be up 38%, but after fees, it's down. It's down 3%. So these are two completely different equity curves, right? So fees are a really big deal when you think in terms of large numbers, because when we are trading intraday, we're going to be taking a lot of trades. Most people who trade on the 1 minute time frame, they take somewhere between 10 to 30 trades per month. So at the end of the year, it's going to look something like 300-ish, maybe 400-ish trades, somewhere in that range, right? So these fees, they make quite a big difference. Now, if I was to increase the size of the average win and also increase the size of the average loss, so what is the percent move that I'm trying to catch, like in a specific coin, right? The bigger the move that I'm going for, and also like the wider of a stop loss I have, the impact of the fees is going to lessen. It's not going to be as bad. So we can have here, let's say my average win is 5%, my average loss is 5%. So you can see here, my actual risk to reward is still 1, but the impact to fees, it's dramatically lower, right? 41% is lost to fees. If I was to really crank this up to 10, 35% is lost to fees with market in and market out. And if I was to crank this all the way down, look at this. It just literally, like this strategy would literally burn money, right? Would literally be down only and burning money. So the fee structure does have an impact on your P&L, and you need to know your numbers. You need to be aware of how much of an impact this actually has on your trading, because once you know your numbers, you can set limitations for what you're willing to go for. So this is actually the reason why the smallest move that I'm willing to capture if I'm trying to enter a trade with a limit order, it's actually 1%. I will not ever go lower than this, because look, if we're entering with a limit order and we're exiting with the market, and we take 300 trades with a 55% win rate, you can see here, yes, the strategy still makes money, but there's quite a gap here. Well, it's still a pretty big gap with how much profit is actually being lost to fees. And this is assuming that every single trade has a risk reward of 1, and I'm not cutting any trades early, right? Assuming. Now, when I'm using market orders to enter a trade, the smallest move that I will be going for is actually 2%. Oh, sorry, 2.5. My bad. It's going to be 2.5. So we can see here that still, after fees, the strategy still makes money, but the gap between before and after fees, it's quite heavy, right? It's still quite heavy. So yeah, this should hopefully really shine a light that these numbers might seem small, but over time they do really add up. They do seriously add up. So you need to know your numbers, and you need to have limits or you need to have some kind of rules for when it makes sense to enter with a limit and when it makes sense to enter with a market, right? And then for exiting, this is how I approach exiting trades. If I'm trying to take profit on a winning trade, I'm always going to be doing it with a limit order. And if I need to take a loss on a trade, I'm always going to be doing it with a market order. So the reason why is because when I'm winning a trade, I don't have urgency, right? If I'm already on side and my trade is going well, I'm okay to patiently wait for it to hit the target, right? But if my trade idea is wrong, I need to get out of that position immediately because I don't want to hold risk in that position anymore because the trade idea is no longer valid. Why am I holding risk in it? So at all times, I'm going to be taking losses with the market order. So yeah, this should really help, or I hope this helps to really emphasize fees are a big deal and you need to know your numbers. Now let's talk about slippage. All right, I want to start by giving a bit of context first, and then I'll explain like what slippage actually is. All right, so if we look at the order book for ton, or ton, T-O-N, the best sell price is at 2.7680 something, right? Because it's always changing. And we can see here the sum USDT, it's fluctuating somewhere between like 3K and it goes up to 10 sometimes, right? And then for the best buy, the sum of USDT, it's fluctuating pretty much at the similar size, somewhere between 5 to 10K. So what does that mean? This means that if I was to market buy about less than 10K, or like let's say less than 1K, the price that I'm going to get for my average entry is just going to be whatever the best sell price is, right? And the same goes for the limit buys. So if I was to market sell or open a short with a market order, and the size, like the position size that I'm using is, let's say, 1,000 USD, the price that I'm going to get is just whatever the best buy price is. And the reason for that is because the size of how much I'm trying to trade with, it is less than the total amount that's available. If I exceed that, so let's say instead of me selling $1,000 worth, but instead I sell, let's say, $50,000 worth, what's going to happen is that I'm actually, like, my order alone is going to eat through all of the available supply up until I have $50,000 worth of ton sold. So if I look here at the sum USDT, I'll be able to see up until when is my order going to hit. So I'm going to, if I look here, I can see that the 50Ks, it starts fluctuating somewhere around here, 2.76 or wherever this number is, right? But basically, I'm going to eat through all of the supply up until somewhere around this point. So every limit buy from 2.762 all the way down to somewhere in here, I'm going to eat all of that. If I'm going to be taking literally all of this, it means that my average entry price is going to be somewhere over here, not actually up here. So yes, it might show that the best buy price is 2.75, right? But my actual entry price is going to be somewhere a little bit worse, right? So what slippage is the price that you wanted to get. Let me just draw it on the chart, 1 second. Let's say I have a stop loss somewhere here, right? And let's say I'm already long. If my stop loss gets triggered at this blue line, which is, actually I might use a different line just so I can see what the price is. It's going to be 2.7534, right? So this is what price I would like to get out at for a loss if my idea is wrong. But if my position size is really enormous, right, like 500,000 or some like very large number, what I will find is that there's actually not going to be $500,000 of orders just conveniently sitting at this specific price for me. So what's going to happen is my order is going to eat through all of the limit buys up until I get 500K filled. And what might happen is my order alone might actually push the price down to 2.74, right? I'm just using a hypothetical example, so just bear with me. And my average price that I got for that one order, it might actually be somewhere here. So 2.7464. So whatever that gap is, let me find where can I measure? I think I'm going to have to, yeah, there we go, got it. If I hold shift and I click at the same time, I can pull this little measurement tool up. So yeah, my average slippage, like my slippage on that trade is going to be 0.24%, right? So not only do we have to be mindful of what are the trading fees that we are paying, like the 0.02% maker and the 0.06 taker, but there's also the cost of slippage. So here is an interactive equity curve simulator with fee analysis that I built in Claude, but not only does it have the fees from the order types used to enter or exit a trade, but now it's also got the slippage in the calculation as well. And this one plots a third line in green to show how my bankroll would look like after fees and slippage. So if I set this to 0, this means that my average slippage per trade is 0, meaning every single market order that I execute, I get the exact price that I want. Now, that sounds all nice and dandy, but in reality, that's just not ever going to happen. We have to accept that slippage is just a part of the game, right? It is an inevitable cost that every single trader has to pay at one point, right? Eventually, inevitably. So if we can see that if our average slippage per trade is 1 basis point, you can see that the impact on the P&L after 300 trades, it's not that big of a deal, right? It's still manageable, right? Like here after 300 trades, the account is still up like 90%. Not too shabby. But if we were to really ramp this up, let's say to 10 basis points, now we've got, like now we're really dealing with something quite nasty. And let's also put the assuming that I'm exiting with a market order, yeah, look at that. Just before fees, the account would be up 120%. After fees, it's up 70%. And then after fees and slippage, with an average slippage of 10 basis points per trade, it's only up, what is that, 27%. So that is huge. That is a lot of money lost, a lot of profit lost just purely to fees and slippage. Like look here at what is this, trade number 138. So before fees it would be up 28%. After fees it's up 15%, and then after fees and slippage it's literally break even. So slippage is no joke, right? Slippage is no joke. This can seriously impact your P&L if you're not careful. So if you're just starting out, this isn't too big of a deal because it's likely that you're going to be trading with a small size, or at least that's what I recommend doing if you're just starting out. But as you start scaling up your account, as you start getting more and more profitable and increasing your position size and increasing the size of your entire trading account, you're going to notice that every now and then, sometimes a trade gets slipped, okay? No big deal, but as you start, I would say as you start getting towards like the 25K size or maybe $50,000 size, it may actually be a semi-decent idea to start tracking what is your actual average slippage per trade. And if that number starts really creeping up to the point where if you look at your numbers and you see that it's like seriously impacting your P&L, you could do one of two things. So option one, you're just going to have to reduce your size on certain trade setups, which are just not as liquid, or you're just going to have to be more strict with the criteria with how liquid a coin has to actually be. before you actually go and enter the trade. I know like this is likely not going to be like 100% applicable if you're watching this video. I'm just sharing like these are the things that you may need to think about. Maybe not right now, but in the future, like as you scale up. But yeah, I just wanted to explain what is slippage and the reality that it will inevitably be a cost that you will need to think about, and it will need to be a cost that you will need to manage and control, or partially control over time. All right, so that's all 5 lessons completed. If you want an extra boost of confidence with using an exchange, then I suggest that you stick around and join me for the bonus training exercise. This is the bonus training exercise. So what we're going to be doing is we are going to be entering and exiting some practice trades together. Okay, so I'll get specific. We will be taking a total of 4 practice trades together with limit orders and market orders, like the 4 combinations. So this is how it's going to look like. Limit in, limit out. So we're entering a trade with a limit order and we're exiting a trade with a limit order. Limit in, market in, limit out, and finally market in and market out. So these are the 4 different combinations of how you could enter or exit a trade with the 2 order types. We will also practice journaling the trades correctly using my custom trading journal, and you can get free access to the journal template from the description. So the goal of this practice exercise is to get you familiar with the 4 combinations of entering and exiting a trade. It's also to help you learn when it's appropriate to use which combination for which specific type of situation. And it's also going to help you get some practice repetitions using a trading journal. This is the order types training exercise, and I have here a Google Doc which explains the exercise in detail, and I also give literal, super simple, step-by-step instructions on how to get through the exercise from start to finish. Now, I understand that at first glance, this may seem really intimidating, like, oh boy, there's 18 steps in this training exercise, but don't stress, because each of these steps literally takes like a few seconds. Like when I wrote here step by step, I literally meant step by step. So let me show you how quickly we can get through this entire exercise. So step 1, open up Bitunix and go to the Futures tab. So Bitunix, Futures tab, click, done. That's already step 1 done. Step 2, click Bitcoin or any random altcoin. Well, I'm already on Bitcoin, so that's step 2 done. So you see, I literally meant step by step. Step 3, make sure that post only is enabled. Yep, it's enabled. Cool. Step 4, now we're actually going to be doing something. Try to place a $10 limit buy order for the coin that you have selected. Just click on any random price in the order book. You will need to patiently wait for your order to be filled. Okay, cool. So I'm just going to click this. I'm going to click 10. Right? Oh, open. $10. Cool. Easy. All right, so now I have to patiently wait for my position to be filled. Now, if 2 to 5 minutes have passed, and by the way, remember, since we're on the 1 minute time frame to do this training exercise, 1 or 2 minutes is just 1 or 2 candles, right? So if I've waited 1 or 2 candles and my position still hasn't been filled, or if I'm feeling a little bit impatient, what I can do is I can just click and drag the limit order and just pull it upwards so that it's closer and closer to the most recent price. So I can click it like this, and then I can click and drag upwards. So this is called chasing the price. Do this until you eventually get filled on your order. So I heard a sound there. So as soon as the order got filled, a little sound went through. So there we go. I am now currently long $10 worth of Bitcoin. Well, it says here 7.9, and that's just because, yeah, I'm working with the literal smallest amount that the exchange allows me to purchase, okay? All right, step 5. After your order has been filled, go to the order form on the right-hand side and go to the panel where you can see 2 buttons, open and close. So it's just talking about this, open, close, open, close. Click close. So it's right under the leverage setting. So it's right here, just click close, done. Drag the position slider all the way to 100%. So click and drag all the way to 100. This just means that when I do try to close out of this position, I don't want to close out of 50% of it. I want to close out of the entire thing. right? Then click anywhere on the limit cells of the order book, or just manually type in a price, which is higher than whatever the cheapest cell is. So I'm just going to randomly click on a price. I'm just going to click close long. Done. Step 6, click close long. Okay, so I got a little bit ahead of myself there. You should hear a noise once your order has been placed, and also your limit cell order will appear on the chart as well. So we can see here, this is where the limit cell order is. So patiently wait for price to move into your limit sell order. If you have waited 2 to 5 minutes and price still hasn't reached it, just click and drag the limit order and just chase the price once again. So, okay, I'm just going to chase the price again. There we go. All right, I'll just wait and see. Will it come into the order? Nope. All right, I'll just click and drag it. I'll just keep chasing the price until it reaches it. There we go, and I'm out of the trade. So I have now completed a limit in and limit out trade. Awesome. All right, next step. Step number 7, now it's time to journal the trade. So I'm going to have to open up the beginner trading journal template. So there we go. Opened it up. Now I'm going to have to go to File and then make a copy. And the reason why is because this is just a template. I don't have permissions to edit it. So I'm going to have to go to File, make a copy. Well, I mean, I do, but it's on another account. But the point is that you won't be able to edit the template directly. The journal will only officially be yours after you make a copy of it. So there we go, made a copy of it. Now, before I do anything, I need to go and clear out all of this testing stuff. So it says here, the trade number, the P&L percentage, and the account balance are automatically generated. Do not delete these columns. So you see these columns where it has like this blue-ish background behind it? Don't touch those columns. There's no need to delete them, because if I delete everything else, which isn't that, it will automatically delete on its own, as you saw there. And we're just going to delete the notes as well. Done. Cool. So we cleared the journal. So step number 8, now it's time to fill in some of the cells of the journal. All right, so in cell B4 under trade screenshot, so right here, B4, it's right under trade screenshot, just type in NA. So N/A. The reason why is because we just don't need to be practicing taking good trade screenshots in this training exercise. And the reason why is because, well, the goal of this exercise is 1, just to get familiar with using the exchange and get some practice with using the journal. That's literally it, right? So don't stress about screenshots right now. All right, let's continue. So in C4 under date, just type in what the date is. Okay, 8 May 2026. What's the coin? Bitcoin/USDT. For strategy, just select other, because this is just a training exercise. All right, step 9, we're going to have to go back to the exchange and find position history. So going back to the exchange, click position history. Okay, done. And then under C4 in the journal, copy paste whatever the profit or the loss of the trade was from using the position history tab on the exchange. So whatever this cell is, I'm going to have to copy paste my profit and loss. So I can just go into here, and conveniently I can just click on this, and then I can just copy paste that. Easy. So copy. Now, when I'm copy pasting, I don't want to just select the cell and press Control V, because if I do, it's going to get weird. It's going to copy it like literally as it is. So it's going to have the black background from the exchange. It's going to be a bit weird with the formatting. What I would recommend instead is do Control Shift V, and that way you're pasting just the value itself. That's one option. Or alternatively, you can just copy paste it directly into here, which is the formula section. Okay, so copy paste, done. Now it's not going to show the exact value in this cell. It will show it in the formula tab, but it's not going to show it in the cell. It's going to show 0.00. This is just because it's rounding to 2 decimal places. We don't want all these decimal places in the P&L. It's just going to it's going to make things complicated. So sweet, done that. Let's see, what's the next step? Okay, step 10. I'm going to have to copy paste whatever number is shown. Oh, no, I didn't finish. Step number 9. Okay. And then in cell I4 under the notes, I'm going to have to type in limit in and limit out. Okay, there we go. Limit in, limit out. There we go. Done. Now for step 10, I'm going to be copy pasting whatever number is shown next to the fees. Okay, so where is the fee? It's right here. Copy. And now I'm just going to add it. There we go. Right, so we just have that number there. So that's the first trade done. Okay, trade number 2, limit in and market out. So step number 11, let's go back to the exchange and enter another $10 sized trade with a limit order again. So I'm back on the exchange. Limit, open, $10. Just going to click anywhere and open it. There we go. I don't want to wait, so I'm just going to chase the price once again. Just going to keep chasing it until I can get filled on the order. Chase it a little bit more. And you can see here the little green dot that appears right here in the order book. This is to help visualize for you where is your limit orders like sitting relative to the other orders in the order book. All right, there we go. We got filled. Let's move on. So step 12, scroll down on the exchange so that you can see your open positions and then click flash close. This is going to immediately close your position with the market order. So I just scroll down in the open positions. This button here, if I click this button, it's going to immediately close out of my position and it's going to use a market order to do so. Done. Easy. So step 13, I have now completed the limit in and market out trade. Awesome. Now it's time to journal it. And I'm going to be journaling it literally in the exact same way that I did with the other trade. So back on the journal, what am I going to put in the screenshot? NA. What's the date? 8th of May, 2026. Bitcoin, USDT. Strategy. Other. P&L. I'm going to go to position history. I'm going to click this button. I'm going to copy the P&L. And I'm just going to paste it into the formula tab to make my life easier. And in the notes, I'm going to put limit in, market out. And I'm also going to copy the fee. There we go. Cool. So that's trade number 2 completed. We're halfway through the exercise. Okay, trade number 3, market in and limit out. So now it's time to take a market in, limit out trade. Go to Bitunix and click market. It's going to be to the right of the limit button. Type in 10 USDT for the position size and then click open long. So let's walk through this, okay? So futures, open, click the market button. Yep, it's right next to the limit button, so click market. Type in 10 for the position size. And then just click open long. Easy. So just with the click of a button, I'm now instantly in the position because I used the market order. So step number 15, close the trade in the same way that I did with the limit in and the limit out trade. So I'm going to have to do the, let's go through it. So click the close button at the top of the order form. So right here, I'm on the order form, click close. Select limit. Done, select limit. Slide the position slider all the way to 100%. Notice how this is a little bit repetitive? That's the point. We're trying to drill the same motions over and over again so that you're, like, if you do it enough times, you will feel that your brain will start to turn off and you'll be able to do these actions on autopilot without even thinking. Okay, so we slid the position all the way to 100%. Next, we're going to select a limit sell price by just clicking anywhere on the order book. So, all right, cool, that's the price. And now just click close long. Cool, easy. Now, if I'm waiting 2 to 5 minutes and I'm still not filled, just chase the price by clicking and dragging the order until the order goes through. All right, so let's say I don't want to wait anymore. I'm just going to chase the price until I get it filled. Let's chase it a little bit more. We'll do a little bit more. There we go. Now we are out of the position. So once this is done, I would have completed the market in and the limit out trade. So step number 16, I'm just going to have to journal it in the exact same way all over again, right? So back on the journal, screenshot NA, what's the date? 8th of May. What's the coin? BTC/USDT. Strategy. Other. Profit and loss. Let's go back to the position history. There we go. Let's copy paste this in. Pasting it into the formula tab so that the formatting doesn't get screwed up. In the notes, I'm going to put market in, limit out, and then I'm going to copy paste the fee. There we go. All right, trade number 3 is finished and it's also journaled. Now, lucky last, trade number 4, market in and market out. This is the last trade and this one's going to be really fast. So market in, market out, let's do it. Go back to Bitunix, done. Select open and click market. So open, market, cool. Type in 10 USDT for the position size, 10. Click open long. Done. Scroll down to the open positions tab. So let's scroll down. There we go. Here's my active position. Click flash close. Sweet, easy peasy. So done. I've now completed a market in and market out trade. Now, the final step is we're just going to have to journal it in the exact same way as we did with the other 3 trades. So let's open up the journal again. Let's put NA under the trade screenshot. Let's put the date in. Let's put in the coin. Let's put in the strategy. Other. Let's copy paste the P&L from the position history. So we're going to click on position history and then click on this button, position P&L. We're going to copy paste this number into the formula section so the formatting doesn't get screwed up. And then in the notes, we're going to type market in, market out, and we will copy paste the fee. Cool. All right. All 4 trades are done. So that is the exercise finished. So see, even though it was 18 steps, it was fairly quick, right? So you will know that you have done this exercise correctly if you have 4 trades in your trading journal. So yep, I've got 4 trades in here. And also the notes are going to have something like this written in them. So I have here limit in, limit out, and then I have the fee, limit in, market out, and the fee, right? So I have done the exercise correctly. Now on the page below, I break down the fees. So I want to encourage you to observe the difference in the fees in your trades. And you may notice the following. You may notice that the limit in and limit out is going to be the cheapest. The limit in and market out, and also the market in limit out, these are the next most expensive option, right? So you can see here, look at the fee here, 0.003. This one is 0.006. This one is also 0.006. And then the market in and the market out, this is the most expensive way that you can enter and exit a trade. And it's going to have the most expensive fee. So you can see here it's 0.009, right? So this is basically the entire exercise completed. There's no strategy involved here. The whole point of this exercise is just to get familiar with the exchange, get familiar with the buttons, which button does what, how do I check the profit and the loss of the trade, how do I see how much fees I'm paying, and how am I supposed to use a trading journal. But yep, that's pretty much it. It's a fairly quick training exercise. All right, so we're now finished with all 5 of the lessons and also the bonus training. Thank you so much for your time and attention. Real quick, if you are serious about improving as a trader, then I would like to invite you to my free Telegram. All right, so this is how the Telegram looks like. Basically, I post a bunch of updates on what am I doing like right now. I also share chart updates as they develop. I share long-term spot Bitcoin type of stuff as well. More chart updates, more chart updates, more chart updates, more progress updates. Here I also share a bunch of free custom trading indicators, but most of the value in this Telegram you will find in the pinned messages. So here I've got a trading journal. Here I've got a giant 214-page guide on my entire mean reversion trading strategy. And also here I have a 100-page guide on how I trade breakouts. Well, this is my momentum trading strategy. And I'll give you a sneak peek of how this guide actually looks like. So this is how the momentum trading strategy guide looks like. I go really in depth. So here are the 9 chapters, literally 100 pages, like literally 100 pages long. In the first few sections, I just go through a whole bunch of the theory. So what are the conditions that we want to see for a good momentum environment, and what are the things that we want to see which confirm that it's probably a really bad or not ideal momentum environment. Then I also cover the entry, stop loss, and target rules. And then chapter 7 and chapter 8, this is where I think most of the juice is. This is where I share 25 good trade examples and 10 bad trade examples. So let me just show you. 50, 59. All right. So I basically ranked, so I have a little cheat sheet here, which grades the quality of the trade based on these 3 variables. Was there a slow grind into the level? Was the volume increasing? Was there at least 2 hours of staircase price action on the left-hand side? And yeah, now as I scroll, there's literally 25 trade screenshots, good trade screenshots for you to study. And you'll notice that through scrolling through a large number of them, you'll notice that they actually all look really similar. And that's the point, that the best trades, they often have really similar or recurring type of patterns which keep appearing over and over again, right? So this one had a giant staircase, giant one-directional type of staircase with increasing volume. Giant one-directional staircase, okay, the volume wasn't increasing, but that's okay. It's still good enough, right? Giant staircase, giant staircase, giant staircase, giant staircase. You get the point. And it also shares the 25 bad trade examples. So this is going to help you, like with repetition, to see what not to look for if you're trying to go for a breakout. So like this choppy sideways price action, not ideal. Choppy sideways price action, not ideal, right? So the whole point of this guide is, 1, to bombard you with a whole bunch of theory so you understand why do certain things work and why do certain things not work as well. And then I bombard you with a whole bunch of trade screenshot examples to just really drill that repetition so you can start seeing the same patterns over and over again. So if you're interested, click the link in the description and join the Telegram.